The theme of the research, or the theme of our report, as you can see, is called Transforming Within for the Outside. And this takes on a number of different meanings, and hopefully as we go through today's research, those become quite apparent to you. But one of the key reasons we wanted to go with this theme is that it means a lot to us as a business as well. You would have seen over the past 2 weeks, and certainly right now as well, we've recently gone through quite a large brand refresh that started not just around the colors or the logo, but it's actually around the vision we have as an organization and how we wish to enact that vision. And that means we've had to review, for instance, various aspects of our business, starting off with our purpose. Before we get there, I'd like to just perhaps introduce your panel today. You've got Janina, who many of you would have engaged with before. Janina heads up our investment consulting space. As one of the country's largest investment consultants, we have a huge breadth of influence across many retirement funds and are responsible for hundreds of billions of rands under advice, where Janina and her team make use of the types of insights, the types of research you'll be exposed to today, as well as within the broader member watch and the manager watch research to craft their advice in a way that helps those funds and their members achieve the kind of outcomes that they're aspiring towards. And myself, I head up strategy and customer experience at Alexforbes. Like I said, joined almost 12 months ago, and it's been a great journey so far. And part of that journey has been working with the business to really dig into what we as a business aim to achieve and to cut to what's our core purpose. So Janine, if you can go to the next slide. Effectively, as an organization, as Alexforbes, we exist. The only reason we're in business is to do what you see on screen. We pioneer insight to deliver advice and solutions that actually impact people's lives. And it's through the breathing life into this purpose that we seek to add value to people, that we seek to demonstrate how we add value in a meaningful way as well. And today is a big part of that, because much of what you'll experience today, and as you work through the breadth of the research available by the team, is around this concept of pioneering insight. And it's what we do with that insight that actually matters most. And as you will see through the various pieces of the brand work that you'll be exposed to over the coming weeks and months, this also ties in very closely to our customer value proposition, as well as to the brand positioning itself, because we wanted to bring this purpose front and center internally so that we can breathe life into it externally. Again, coming back to the theme of the research, which is about transforming within to have that impact externally as well. So when you look at our brand, it's around insight, it's about advice, and it's about impact. And it's through the delivery of that promise that we now create. We as Alexforbes wish to add value to yourselves as stakeholders, but to the customers and clients that we serve. As a business, we've been conducting investments business for the past 25 years, and it's been quite a great journey through that period. This year, we celebrate the anniversary of, through various business names and iterations, what's now known as Alexforbes Investments. So it's been 25 years of leadership, thought leadership, the research, acting with professionalism and integrity, and taking the insight and advice that we build and infer from the research to craft the solutions through our multi-management platform in a way that we believe best achieves outcomes for our clients. I mean, many of you would be aware of the various portfolios and innovations we've delivered over that period, including, for instance, Performer itself, which ranks quite highly, as you'll see as we progress with the research. But this year is our 25-year anniversary. Coincidentally, it's also the 25-year anniversary of the Alexforbes Retirement Fund, our flagship umbrella fund. And so there's a credible track record of delivery that we've managed to build through these respective capabilities. At that point, I'll stop speaking and hand over to Janina. But before I do so, I do want to just add that we have set up specific time at the end of Janina's slot to handle questions, and we'll go to that stage. But throughout her presentation, please do feel free to pop comments and questions through to the chat box. We'll try and address them via the chat if we can, but it helps us keep track of the types of questions you've got so that we can make sure that we address each and every one of them in the time that we have available. Thank you so much. And Janina, over to you.
Yes, thank you very much, Faresh. And great to see you all online. It is very exciting this time of year to launch the survey each year. And Don Andrews, who is the author essentially of the whole survey, is also online. So he'll certainly help me with any of your more technical questions you might come up with later in the day. But I think you are aware just how proud we are of this survey. It's come a long way since it was first launched in 1994. And we really do see it as the Bible of the asset management industry in South Africa. We do get a lot of questions over the course of each year in terms of the different surveys and the data. I think the directory at the back of the booklet gives a great set of information if you're wanting to find out anything about any of the managers in South Africa. So we really do see it as something that should be core to giving advice to clients, for clients to have information on their managers and so on. Maybe just to summarize some of the key milestones since we first launched the survey in 1994, as I said. Obviously, one of the most watched surveys is the Large Manager Watch, and that was launched in 1998. So a significant history of the largest managers in South Africa with multi-asset class mandates. And as I said, often used as the standard against which any of the managers to be appointed by clients is considered. We have spent a lot of time over the years, obviously adding surveys, so now 22 surveys in total, and you can see the progression in terms of what was added when. But I think also key to keep emphasizing the fact that we've looked oversight of the governance of these surveys. So special mention over the years in terms of when survey governance was formalized, when rules have been reviewed, etc., because that is actually critical. If you're using these surveys, you do want to know the credentials are correct and calculated correctly and consistent, etc. So that is something that Don's team does spend a lot of time on. And very proud to note that for the last 3 years, these surveys have won us the Africa Global Fund Award winner. So 2019, 2020, and 2021. Very proud to have that recognized in terms of the quality of the survey that we put out to you each year. Just to give you an overview of who's in the survey this year, there is 79 managers with 542 strategies. So in fact, a net increase of 2, but in fact 5 new managers in and 3 out. And obviously managers do come in and out. They obviously have to have certain criteria for a mandate they put into surveys. So there could be reasons why the data no longer meets the requirements and therefore they go out, but nice to see them also sometimes coming back in again. So a net 2 increase, but massive increase, in fact, in strategies. And you can see at the bottom just a summary of where they've come and significantly in the BE space. A lot of detail, obviously, in the actual survey, but BE and transformation generally is a massive theme. We have highlighted it in previous years, and you can see it's coming through even more strongly this year. We are seeing clients asking more and more to have transformed managers and transformation in the broadest sense. Later on, I will emphasize level of BE credentials for some of the managers, but it is much more about the full transformation. So transformation of the investment team, transformation, if possible, at the ownership level, etc. It's a massive focus on transformation, therefore not very surprising that new entrants have been very much focused in the BE space, but also some of the others increasing, particularly multi-manager, and interesting to see an increase in the absolute return mandates as well. In terms of the number of participants across the surveys, as always, it is equity strategies that have the highest number, and you can see an increase 2020 to 2021. And not surprisingly, a lot of new houses that start up. So again, coinciding with transformed manager statistics. Often they'll start in the equity space and then over time graduate into multi-asset class. Obviously, we do get some startup managers focused on bond strategies, but a lot will focus on on equity mandates, and therefore not surprising that is quite an increase. Also interesting to see, as I mentioned, an increase in the number of absolute return strategies. They seem to have decreased in popularity amongst clients, so quite a decrease in the past, but now seeing some increase in the last couple of years. This just then summarizes all of the participants across the various surveys. Within equity, we do have non-benchmark cognizant and benchmark cognizant, and significant increase amongst the benchmark cognizant, to some extent driven by allocation to more passive type strategies or smart beta, but still quite a number coming through in terms of non-benchmark cognizant, staying quite constant, but significant increase of additional 7 over all equity strategies in the last year. Then to move to the total asset managers, top 20 by assets under management. The biggest change you'll see, which we do refer to in the survey, is the decrease of OMEG from first to sixth. And this essentially relates to the change in the overall structure. Obviously, they have included global assets managed by partnerships within the old mutual group in the past. And now essentially that has been unwound. So it is a delta change for this year in the OMEG assets. But we should see a normalization for assets they report going forward. So apart from that as being the most significant, we have seen 91 now rise to number 1, followed by Stanlib, Coronation, and SIM remaining at level 4. In terms of the other managers, quite a nice increase for Quanta, offsetting Sanlam multi-managers. And then at the bottom, the Momentum Manager of Managers, or Mutual Multi-Managers, and Fairtree, leapfrogging, especially Prescient and ABSA Asset Management. Nice to see some broader names that are coming into these largest 20. And again, a theme of smaller managers growing quite substantially, as we've seen in the last few surveys. The percentage allocation to the top 10 managers has gradually been decreasing over time. So again, a slight decrease from 2020 to 2021. But what's also quite nice to see is that it's not just the top 10 and the next 10, but also the remaining managers starting to gain some significant percentage of assets. And I guess that's a general theme, but there are a lot of smaller black managers who are receiving assets, but also generally smaller managers. Obviously, it is quite a concentrated market. If you're too big, you might have to hold only the biggest shares. So clients do look for smaller managers who potentially can be more nimble and make allocations to mid and small caps. And then very exciting, this is definitely something we want to showcase in terms of the results coming out this year. Again, consistent with trends in the past, but now hugely significant. That majority of assets are now being managed by level 1 contributors. And if they're not level 1, then they are level 2. So your top 10 managers, 7 out of the 10 are level 1 and 3 are level 2. We have always had a few managers that have remained unrated. We would want to see that decreasing over time. We do see generally a lot of passion from managers in terms of wanting to be transformed and to get to level 1. So the unrated over time should reduce, and we do see trends in terms of managers moving to the left. A little bit more mixed. If you go to the next 10 managers, 6 are level 1, and then some distribution across the boards, and then the remaining similarly, only 44% level 1, and quite a spread across the other levels. But I think this does demonstrate a major commitment of the asset management industry to achieve a good BE rating. Although, as I said earlier, it's not just about your BE rating. Clients want to look far more in detail. They do want to see the composition of the investment team, and some clients very specifically want to see the level of ownership. So not just your level, but all those other elements. We do see it as positive that so many new Black managers are emerging, but we do recognize the challenges faced by new managers. So do watch this space. This is something we'll be spending a lot more time on in the next few months. And next time we meet with you, we hope to share more detail in terms of where we are assisting Black managers to gain scale and set up the structures they need in order to succeed. And then the last big theme in this section, before we go into some more detail of the actual returns, is the commitment of asset managers to responsible investing. So the two key indicators we look for is whether they are aspired or at least use CRISA, as well as whether they are signatories to PRI. And you can see a dramatic increase in both of those categories in the last year. Obviously, CRISA, you just have to adopt the principles. PRI is a lot more onerous. So not all managers will tend to do PRI. There's annual reporting requirements and so on. But very nice to see that despite some onerous reporting requirements, asset managers are committed to responsible investing and have actually signed up for PRI. Going from 34 to 43 is a significant increase over the last year. I'll now go into just more detail of the actual surveys. So what do we see in terms of what managers are actually doing? First of all, starting off with the South African best investment view, where, as you would expect, the equity allocation continues to be the largest, quite significantly up at the end of 2021 versus prior years. Obviously, equities had a good recovery, just to some extent driven by actual returns, and obviously at the expense of other asset classes, although South African bonds continue to be a very favored asset class. In terms of global, obviously close to the top in terms of the maximum 30% outside of Africa, that did apply as at the end of 2021. At 27%, quite a large dispersion within the category. Obviously, some managers more positive or negative in terms of rand versus dollar. And obviously, the rest of the class is fairly proportionate. SA equity, obviously, a major allocation as well in terms of global best investment views. This obviously is the picture that's going to change dramatically going forward with the change in offshore limits to 45%. We do see this as a major change in the whole industry. I think when you had a maximum of 30, it was easy for most managers to just drift around 30. They didn't necessarily have to have strong views on the rand. Now they could range from 20% to 45% sort of thing in terms of implementation of views. And the return distributions we're going to see are therefore going to be vastly bigger than they've been in the past. And we do expect to see a lot more focus on taking currency hedging in terms of hedging back to rand or taking protection against appreciation, etc. I guess we would summarize to say that asset allocation skills will demonstrate far more in terms of dispersion of returns. The ones that get it right, particularly in terms of local offshore, will definitely be way above others in terms of being at the top of the survey. And obviously, we also expect to see a change in that allocation to SA equities. At the moment, we have a very concentrated JSE, whereas going forward, you have the ability with 45% potentially offshore to go and get a much more diverse basket. So, for example, have a basket of tech stocks internationally as opposed to exposure mainly to Tencent through the local market, but potentially not necessarily in dollars. The exposure could be hedged back to rand. So interesting to see how managers actually implement this going forward and what its impact will be on the whole asset management industry. I will just refer to that at the end. In order to introduce you to the various specific surveys and the range of returns, as always, I introduce you to the box and whisker plot, which essentially gives you highest and lowest return as well as median and first and third quartile in terms of the returns. So starting off with equity, where as you would expect, this is where you see the widest dispersion. Equity is traditionally the most volatile asset class. Listed property is actually also traditionally almost as volatile, but you can see a lot smaller dispersion in the last year, and then bonds very consistently a much smaller dispersion. In this year, equity and property were the winners. Property, after a very poor period, had a good recovery, but essentially not many differences between managers of property portfolios, given that the number of counters available is relatively small. As you would expect, if you look at the equity returns over longer time periods, the dispersion reduces. Unfortunately, a very consistent theme in our South African equity market is that we haven't had great returns over longer time periods. So you can see less than a 10% return at the median over 5-year periods, and very difficult to deliver CPI plus real returns when that is the level of returns coming from the equity mandates. So that has caused a lot of problems, particularly for defined contribution funds who use equities as a strong driver of returns to build up members' benefits before they approach retirement. So a lot of challenge. Nice to see recovery, but even the 3 years still too low to give great real returns, and even worse over the 5-year period. Property, as I said, much smaller dispersions than equities. Great over the last year, but definitely more pedestrian, and in fact negative over 3 years, 5 years. A lot of challenge in terms of allocation to property mandates in our market. And then bonds, just to note, the scale is different on the left-hand side to the other graphs, so much smaller dispersions, and obviously the actual average returns a lot more similar over 1 year, 3 years, 5 years. Not seeing significant differences as we do see in the equity and property space. And then to look at the global large manager watch universe, so similar graph, and obviously quite correlated with what happens in South African equities, and your dispersions reducing over time, and unfortunately ending at 5 years at less than 10%. So while that does still give real returns, it's certainly not the level of returns we've seen historically, which have given massive returns, excess inflation. This just gives you a summary of all of the performance of the global large manager watch, being the best and worst performers from 1 year through to 10 years. You can see the number of funds decreases over time, because obviously some of the funds that were there 10 years ago are no longer here, and therefore not included in the overall graph. As you would expect, the median somewhere in between, and just to showcase where performance sits, which is obviously the multi-asset class that is actually benchmarked to the peers. So the fact that we have managed to outperform the median is something that we are extremely proud of. And this shows you the rolling 10-year returns on the global large manager watch. So very consistent, in fact, if you look at the last few years, and this really is the message that we've been giving for some time, that it is a relatively low return environment. There were reasons why we got higher returns in previous periods. We're not really expecting to return to those levels we could see several years in a row of getting 20% returns from your multi-asset class mandates. Settling around the 10 to 12% level is expected to continue, although obviously a lot of factors driving our expectations of the coming 10 years, including the ongoing geopolitical concerns and the fallouts of where we are currently. And the last couple of slides in this section, first of all, looks at the equity benchmarks in use. This has been a challenge that, depending on which your equity portfolio was benchmarked against, you could have vastly different returns not related to manager skill. So specifically of the last year, the all share, which obviously has got no allowance for the shareholder weighting or any sort of capping, returned 29%, and obviously driven quite a lot by resource counters having done well. Whereas the SWIX, which caps the inaccessible shareholdings, and therefore does tend to reduce resources allocation, was only 21%. And then in this period, capping, particularly process and Naspers, actually gave a high return for the caps WIX. So most funds, 52% in the last year, are using the caps WIX now to benchmark their equity returns. And that is a significant trend that we've seen over time. Obviously, some challenges with caps WIX at the moment, with a sort of artificial capping of the process and Naspers, and the JSE still reviewing how to manage those exposures going forward. So potentially seeing something different with caps WIX in the future, and that could obviously change which clients decide which benchmarks to use. And then just to end, I've spoken quite a bit about transformed managers, and clients definitely asking us a lot more about transformed managers. So it is quite nice to showcase where we have seen managers doing well. So Taquanta second in terms of money market survey, Prescient second on specialist bonds, as well as first on ILBs and first amongst flexible income. Kahiso second on, at least their new name should have come in here, on domestic balanced, and Perpetua third on the global balance side. It's also quite nice to see different mandates, so not just specialist mandates, but also coming through in the domestic and global balance space, where obviously a lot of clients are still allocating assets. And then we come to fees. This is a part of the survey that I'm sure you all are very interested in each year, and our clients do ask us a lot of information about fees and to get a sense of where their fees stack up against other managers. So essentially what this shows you is the levels of fees, maximums, minimums, and averages. We'll say that unfortunately a lot of managers are reluctant to submit to this part of the survey. It is voluntary. So the number of participants is actually less than the number of participants you'll see in the individual surveys, and also not willing to give a lot of detail. So for example, giving combined fees for global mandates, as opposed to historically where we could get a split between the domestic and international. So you do have to have some skepticism as to whether this is really indicative of actual fees in the market. And as to whether the medians are a good sort of benchmark for clients to use. And as you can see, certainly looks like Global Absolute only ended up with one participant, although we have more than one in there. It just looks very similar, in fact, all the same. But the trend you would expect that your money markets and fixed interest mandates do have the lowest fees. Equity and global have the highest fees in terms of the fees, and particularly global, where if clients aren't going for passive mandates, the fees can be significantly higher than for domestic mandates. I am getting to the end sort of the detail of the survey, so I'm looking forward to some good questions and discussion in terms of the chat at the end. But it is also good just to highlight the full spectrum of what is included in the survey. So the actual numbers and the detail is essentially what I've focused on so far, and obviously very much focused, as I said, on elements related to, for example, transformation, as well as responsible investing, but also some important articles for you to review. Interesting to combine views on the budget with ESG considerations. So actually a very interesting article from our head of responsible investing, with Pramel. Also just looking at impacts of the pandemic. Obviously it's been a period of significant volatility in various asset classes, and just when you think COVID's going to get to Russia-Ukraine conflict. So just emphasizing the benefits of diversified portfolios. Delve into the ESG conundrum in terms of the role of retirement funds, and obviously a lot of focus from the regulator and the concepts coming through in terms of expectations on reporting, sustainability, etc. And obviously quite keen in terms of fund members. It's their money after all, and understanding how it should be invested for a responsible perspective. Also getting views from 5 managers, looking at how asset managers transform within for the outside, as we emphasize at the start in terms of the overall theme, but just giving different ideas on growth, inclusivity, and sustainability in terms of what they do and how it is rolled out to clients. And then just a bit more detail. I'm sure you want to read this one on the rationale behind our Alexforbes brand refresh, which obviously Paresh has covered. And as I said earlier, the whole package in terms of the booklets, the end section with directory is a great way for you to keep track of who's who in terms of the asset management industry. It's really great to read the whole booklets and not just focus on the specific surveys. In terms of our insights that we gain through the surveys and how this influences our advice and solutioning, obviously we do see it as critical to have access to surveys such as these. Certainly from our consulting side, this is the way we take quality information to our clients in terms of how managers they appoint are stacking up against other managers, but also some of the key criteria which we've shared with you today in terms of transformation statistics, commitment to transformation, and fees. So these are the elements that we actually take out to our clients. And as I said, transformation, this is actually a topic we deal with every day now with our clients, maybe to some extent driven by the concept of the scorecard coming through for retirement funds in particular. But it's not just about the BE level. That is obviously the easiest to bring into a survey like this, but they also want to know who's managing their money, the money of their members. Is the investment team transformed? Are managers actually committed to ESG, and where do fees stack up? We haven't yet seen a lot of allocation towards passive within South Africa. It's actually more common in the international mandates. But fees and pressure on fees is definitely an ongoing theme. And then to end, just with some forward-looking views. Obviously, we use the surveys to give us a view and a snapshot view of what's happened to date. But we do see some very important trends coming through. And this is where we're trying to give you a crystal ball view of what could happen in the future. What are the types of trends we're likely to see and that will come through in future surveys? Allocation to majority Black-owned managers we see as becoming an imperative. You have seen pressure coming from National Treasury. It's coming through scorecards. And a lot of our clients actually have mandates. They actually want a minimum allocation to majority Black-owned managers. So it's not so much the BE level, it's the majority Black-owned. So you have seen that a lot of Black-owned managers are getting assets, and that will definitely become more and more of a critical in the future. We have reported in several of these types of sessions about consolidation of the asset management industry. This is a key trend internationally and will expect to also be a key trend in South Africa. And obviously, the level of assets you manage to be a sustainable business, there is a minimum, and a lot of managers don't get to that scale. So we do see mergers, acquisitions, etc. So specifically the Quanta takeover in Gwedi in the past year. Those types of transactions we will expect to see going forwards, and a continuing theme in terms of the dominance of the Black-owned asset managers. Larger existing managers will increasingly face challenge due to lack of transformation. I think the large managers have shown a great commitment to transformation, to their BE score, to their investments into up-and-coming investment professionals, etc. But some of them do have an issue with their ownership. So we as consultants have had to terminate large managers because they're not meeting the mandates coming from clients, which require a minimum allocation to Black-owned managers. So this is going to be a challenge for the larger managers, and responsible investing similarly will become a license to do business. It's a minimum. If you're not meeting those minimums, you will start to lose assets in terms of asset managers. ESG and the transparency of reporting is a massive challenge to us as an industry. but we are making progress. So more and more US clients will be able to look at an asset manager portfolio and assess it in terms of its ESG credentials versus alternatives. And we do expect to see clients being far stricter in terms of what they want to see coming through in terms of hard reporting and hard trends in terms of improvements. So that will be a massive shift. Offshore, as I said earlier, is a massive decider going forward. When you can take 45, you have to have a clear view on the level you want to take in terms of quantum, where you're going to allocate it. So just your traditional ACWI mandates going DMEM, or specific allocations to developed emerging markets and then within regions. So Africa, China, BRICS, etc. Those will all become far more critical. The successful managers will be the ones at the tops of surveys, and the others that don't get this right will be at the bottom. Asset class allocations, as I said, we do expect to see some sort of shift from local equity and particularly to global equity in order to get diversification, although not necessarily keeping the exposures in dollars, and currency hedging. This is not a topic that's necessarily been widely used across portfolios, but it has to be in future. If you take 45% offshore and the rand surprisingly strengthens, as it has done in the last month, the negative returns you get are going to be quite shocking. But currency hedging obviously can protect those. And just reality is that smaller local managers who don't have offshore partners could lose assets, because if 15% does move offshore, they will lose out. That, as we've said, is the last point. Global partnerships will become even more critical. You have to have a way to get client assets where potentially it's 45% of any assets being allocated. So obviously actual partnerships to manage assets, but also the global research and scale. And we do think the managers that manage local assets, the quality of those managers will determine flows. We know the JSE has had a lot of delistings, so your ability to choose the best JSE shares as opposed to almost just holding the benchmarks is going to be a critical skill, and then the decision in terms of how you manage offshore. This is specifically going to fundamentally change our market. If I was going to call 2 or 3 major trends, definitely transformation and offshore, as well as the responsible investing overlay, I think will be critical.